Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's July 26, 2019, episode 38. I'm Patrick Ceresna.
And I'm Kevin Muir. Thanks for joining us this week. Today we are joined by Zach Abraham, who will be giving his view from the West Coast. And for our WTF segment, John Chambers has a midlife crisis.
All right, and this week in trading history, we're going back to the panic of 1893, and then we're going to do the top 5 things to watch this week.
Okay, let's jump right into it. Lena, why don't you hop on and tell us about this week's beer sponsor?
This week's beer sponsor is Carbon 4 Brewery, Fantasy Factory Beer, India Pale Ale.
That's right, and this one's actually from our American friends, is it not?
Yes, it is.
Yeah.
And there's a long description that comes with it.
Well, why don't you just give us a sentence or two? Not the whole thing. Those Americans, when they start, they just keep going on and on.
It's crucial. Every word counts in this one. I read it over a few times.
All right.
Hophead's crusade on a heroic quest for the holy grail of India Pale Ales. The subconscious composes paradisiacal scenes of multi-waves crashing on a ripe lupulin landscape, cascading hop flavors and aromas in profuse abundance. With humble confidence, we offer this brew as fantasy-made reality, balanced in every detail and gushing resinous, exceptional citrus flavors and aromas that collaborate with soft, bready notes surrendered from premium English golden malted barley. This beer is a tropical dreamscape. Epic.
Yeah. Well, listen, I got to give a little more history here because, this is from my good buddy who I've nicknamed the Man Bear Pig, and he brought us this.
Man Bear Pig.
First of all, it's from Madison, Wisconsin, right? And so it was a local where he's from, but the picture is epic, isn't it? I'm convinced. Okay, so those that aren't seeing this, there's a cat riding. I call it that's Jared Dillion's cat riding on Kevin Muir's inflation unicorn, breathing fire onto all the doomsdayers that inflation is coming. It's a perfect fantasy factory beer there, isn't it, Kev?
I'm just going to let that go. And I've already started, by the way. And it's old school. You need an actual can opener to get it, which I like. And
bottle opener.
Yeah, bottle opener. I'm using a can opener. But anyways, it's pretty good. Why don't you guys hop in there and see what you think?
Oh, no, this is a fantastic beer. This is I can't wait to rate this at the end.
Okay.
Yes.
Well, let me go. Let me do my legal stuff I got to do. Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com. Side effects of too much market. I'm already having trouble with the side effects of too much market huddle may include auto brewery syndrome, jargon aphasia, and or trench mouth. Something of which I think you had all three on Sunday, Patrick.
I did. By the way, just before we switch pictures, on our intro picture, we have us looking a little way too serious for the SmackDown. I think
that was because we were hungover. It was Sunday morning. We'd gone out Saturday, and it was a little early. That's why we were looking so serious.
And there's the picture of a bunch of the huddlers that showed up. It was a great crew. I think between the speakers and everyone, I think at a peak we had about 30 people there. But it was so great. Some of us went the distance and drank right into the morning, and others.
Some people said they asked who won the debate, and that's still up in the air, but we definitely know who tapped out first and who was having a little more trouble handling the beers.
Oh my God! You know what? Someone served me it was an 8% beer. It was some sort of sour, but it was the Ninja versus the Unicorn. It was some Chicago craft brewery. That hit me in the teeth. It was
I got Patrick. Someone was kind enough to give me a Dragon's Milk.
What the hell is that?
It's an 11% stout.
Oh, the one that took you 3 hours to drink?
Yes, it was. Okay, let's go on to the markets.
All right.
Enough beer
All right.
talk. And now we have the pleasure to welcome Zach Abraham from Know Your Risk Radio, and he's the CIO of Bulwark Investment Management. Zach, it's a pleasure to have you here.
Hey, pleasure to be here, guys. I've been looking forward to this. Big fan of the show, and it's the funnest podcast for sure.
Yeah.
I really enjoy it.
So I was kind of laughing because usually you're the guy asking the questions. I've been on your show a couple of times. It's always been a lot of fun. You've always we've enjoyed chatting about the market, and now I figured it's time to turn the table and ask you what you think about the market. The S&P is hitting new highs here. You're always one, that's willing to kind of stick your neck out and say something provocative and exciting. What do you think about this S&P up here?
Oh, I think it's patently insane. I think it'll be interesting to say we're talking 20 minutes from the close right here. 30.20 has been a technical level that we've been watching for a variety of different reasons. We're sitting at 30.27. But the other side of it is it's probably about 3 or 4 years ago, honestly, I looked at it and said, look, this is going to be a different kind of deal. This is not your garden variety bull market, obviously, on so many different levels. And, one of the things we've talked to our clients about is, it just looks so primed to roll over. And I think I really think that it could, not saying I'm predicting that at all, but it could make 2008, 2009 look like a picnic for a variety of different reasons. Yeah. How's that for hyperbolic, right?
I love it.
But then again, I wouldn't be shocked to see us go full blow off or what we refer to as retard mode. That's not politically correct, but you guys don't have to deal with the FCC like I do. So, but yeah, I wouldn't be surprised to see us tack on another 30% from here. I mean, why not, right?
Really? So you're in that camp where we're going, let's say, 3,400, 3,600 on the S&P. It's just going to go retard mode on the upside, and then we're going to blow off on the downside. I can't believe I'm using the word, but okay.
You guys, okay, listen, it's Kev Gutting in here. As the sober Canadian, I have to say we have to stop using that. It's not appropriate, boys. No more. Okay, leave that one aside. Let's just leave that aside. I'm sure we can figure out something insane or something more
edit
appropriate.
Out.
No. Anyways.
My wife is going to hear this and slap me for that.
Your wife listens because mine doesn't listen to anything I do. But
Neither
anyway,
does mine.
Let's go on. So you think that the market's super extended. I know we've talked a lot about the debt levels. You're one of those guys that's worried about it. You think that it can't, this has got to end badly. You're looking at all these things. What sort of stuff are you watching that's kind of giving you the greatest cause for concern?
I think it's being more of a classical value guy. Which, needless to say, has been like surviving a nuclear winter these last 5 or 6 years. But just the extension. I just got done doing an interview with Jesse Felder, and we were talking about some of the, some of the bellwethers, even like a McDonald's. Kevin, I know you and I spoke about Boeing extensively back before the trouble started in February. Just looking at the fundamentals in relation to the price that we're paying. And then not even really considering the debt in this situation. There's so many of these, Coca-Cola. Revenues are down something like 25% over the last 3 years, and they're trading at a 34 or 35 multiple. Yeah. McDonald's at a 30 PE. This is just nuts. It's it's not how, in my opinion, and I can be wrong. God knows it's happened before, but on a fundamental level, you look at it and just go, look, it's not if you're going to lose money if you're long these names, it's when,
And do you think it's the whole market, or do you think it's specific to those kind of defensive names that people are chasing in an attempt to try to figure out a way to replace what used to be, used to get from fixed income? It used to be you could go buy a bond, a 10-year that might yield you 4 or 5%, and now you can't find that. So people are rushing into these kind of high dividend paying stocks as a kind of a proxy for that.
Well, that's a funny one, right? Just the word fixed income. Now, in a lot of places, it's fixed expense, right? We're not even getting income.
I've never heard that used, but that's awesome.
Well, I mean, you look, there's just these anomalies everywhere and look, man, I mean, we're all in a performance-based business. So you feel the pressure of wanting to run after it and catch up, but you just know that you can't do it. And I see it all over the place. The one place we're finding value right now, perceived value, we'll see how it plays out. I feel like an idiot a little bit. You feel like you're running into the fire, but retail, I mean, that's really the only place we're seeing substantial value, honestly.
You don't think the energy sector has some value?
Oh, yes. Okay. So I take that back. I think that things, especially if you've got the outlook, which I do, of a stagflationary/inflationary environment kind of going to be the next role, there are some energy names that look attractive to us, a couple that we've added recently and that we're looking at. There definitely is there. I think that kind of what happened in 2015, 2016 really cleared out some of the muck, and there is some attractive names there. But just in general, like I said, we hired a new, so funny deal. My uncle used to run a money management firm down in Panama. And they specialized in special resources. They did a lot of different deals with Rick Rule and Sprott, and he had about 25 brokers working for him. And he recently came on as an advisor to our firm because he sold his firm about 4 or 5 years ago, and I kind of coaxed him out of retirement. And we're driving down the freeway, and he looks at me and he goes, "Why aren't you just focused on the classic value names? Just write it out." And I go, "Like what?" And he started pulling them out, Procter and Gamble, McDonald's, and I just started ripping through them one at a time and going, "There's no value there."
Right.
It's insane. And that, I think that is really, I think that the way that you guys talk about it being some value in miners on the gold side, I think there's clearly some value there as well, on the energy side. But I mean, you get outside of those few pockets, and it just, you can't pencil it, right? I can't even make an argument of why I would justify going into those things. It's just, you kind of feel like your hands are tied, at least from our perspective.
So what do you see on the retailers that's exciting you?
Well, one that I recently did a podcast with Toby Carlisle. I was on his podcast, and I hate to talk about it because it's been a house of pain for us, but there's a company called Tailored Brands, and everybody knows them.
What's the symbol on it?
TLRD. And if you look at, so if you don't know it, you do. Buy 3 suits, get 1 free. Joseph A. Bank.
Okay. Oh, I know Joseph A. Banks. Oh, yeah. So they bought Joseph. Yeah, okay. Oh my God, it is a house of pain. I can see the chart already.
Yeah, so that first crossed our blotter, I want to say, and don't quote me, around 2015, and we got in an average price of right around $13 a share, I want to say. We had a fair value target on it at 29. It hit our target. We sold it. We held it for, I want to say, 16 to 18 months. And then I did what I almost never do, which is it got hammered again. And we staged in our, thank God, we staged in our purchases, and we took a stake down at 13, picked up some more at 8, and picked up a little more at 5. And the thing is just getting crucified on the short side. It's got some fleas. There's no question about it. But if you guys want to get into that, we can talk about the reasons why we think it's way overcooked to the downside. But essentially, you've got a company that's cranking out somewhere between 150 to 200 million in free cash flow with a $235 million market cap.
What's the bear argument? Like, where do you differ from the bears? Like, what do you see that's different than what the bears think?
It's funny you ask that because we've spent a lot of time researching the bear thesis. The bear thesis is it's going bankrupt, and it's a flawed business model because you can't sell 3 suits for 1. So let's start there. They no longer do that. They quit doing that almost 3.5 years ago. I was reading a bear newsletter that came out just a month ago on why it was a sell, and they were citing that. Well, they haven't been doing that for 3.5 years. Now, the acquisition they made of Joseph A. Bank was an absolute disaster. They way overpaid for it. And everybody cites the decline in revenues, but the decline in revenues for the entire company is almost solely attributable to Joseph A. Bank. The core business, the real value we see is Men's Warehouse, and they've really muddled through this whole retail apocalypse pretty cleanly. You know, and one of the thesis we had, or part of the thesis we had getting into it was, look, yeah, retail is going to get pressed. You know, the Amazon effect, the internet, I get it. But men's suits are something that not a lot of guys are going to start buying online. There are some, but we thought it was going to be one of the most durable sectors. As it relates to Men's Warehouse, that's been the case. It's been very steady. And it's a cash flowing machine. One of the reasons for it is they're not a true retailer in the sense that they're not selling other people's goods. They're selling their own. They've got several other brands in there that aren't even figured into the calculation, like K&G and Moore's. And I haven't done a deep dive on those. Those don't look like great businesses, but they've got some that are, like Joseph Abboud. They own that brand. I think it's a great brand. I own some Joseph Abboud suits, love them. And so this thing has gotten crucified because it's going out of business. And I was talking to Toby Carlisle, looking at the fact that they're paying a 14% dividend right now just because the stock's been beat up so bad. And I'm really hoping that an activist investor gets in there, because the company also has, and again, don't quote me, I don't have my notes right in front of me on this, but they've got a $450 million revolver that's available. I mean, they could, and I think their cost on that is like 6.5 to 7% a year, or less than half of what their dividend rate is. This is a company that could step up and buy 100% of their equity themselves and improve cash flows at the same time, because they wouldn't be paying the dividend on those stocks or on the shares, right? So, right. It's not fun. I've gotten a lot of client calls. You know, it reminds me of Top Gun. You know, where you're gonna do what? You know, but we've done our research and we like it.
Yeah. So one of the things you mentioned is you brought up Amazon. Now, being from Seattle, like you are headquartered in Seattle, is that correct?
Yep.
Yeah. So you must have kind of an opinion and like a on the ground kind of opinion on Amazon. Why don't you walk us through what you think on that stock and the whole kind of what they've done to the rest of retail?
Well, yeah, that's a tale of two cities, because I think it's an incredible company. I have been wrong about Amazon for a very long time. And then about the time that I swung, which is probably 5 years ago, I kept setting entry points and would just miss them. So this is not sour grapes. I'll be the first to tell you I missed it. And then on top of that, every time I come home, I see 4 different Amazon boxes sitting on my front doorstep. So it's kind of it's like a recurring slap in the face, right? But
I get that all the time from my wife.
Yeah. So it's a. I think that there's, and again, I've talked to, Toby and I were talking about this on his podcast too. I think there's a big leap of faith if you look at a lot of the growth that's built into that story, or a lot of the juice that's built into the price of their stock. Everybody goes back to AWS. And I think that this whole cloud computing rage reminds me so much of telecom in the late 90s, meaning that it's all the rage right now because everybody's got pricing power, right? Because everybody's flooding into this space, but it's just primed to be commoditized, in my opinion. And I just see that, I see these margins slipping. When we get into an environment where they're battling for business with each other, it's just going to turn into a price war. I mean, there's so little differentiation between the offerings that all of these cloud computing type, companies are delivering right now. And, they're great businesses, man. We use it. I'm not knocking it. It just is the prime setup to me where we're extrapolating out these profits and these margins, and it's not going to hold. There's just no way. I mean, they've got all these server farms. The minute you get into an economically depressed cycle, they've got to, the more people they add to those server farms, right, the better it is. So it's just going to turn into a price war. That's at least the way it seems to me. And I just don't think that their price or their current valuation is sustainable at all.
So it's one of those classic examples where the market is extrapolated way farther in the future than the reality you could ever imagine. Now, the other one that we talk about extrapolating farther in the future is Beyond Meat. What do you think about that? Like, that's another kind of crazy name, right?
Yeah. Well, so, and we're not governed by, but I think it's a shit show. I mean, it's a dumpster fire.
You can say it's not. We swear all the time, so go crazy, buddy.
Okay. Okay, yeah. So and I got to stretch that out because, like I said, I'm not under FCC rules right now. So we got in this exchange on Twitter, and he was passing around. Funny enough, he was doing it with David Rosenberg, which I thought, okay, this isn't going to go over very well. But he was trying David to read his 10-year projections for Beyond Meat, and my first response, and again, not to be a jerk, because we've all been wrong, but I said my first thought was, something tells me that this cat did not manage money through 2008, 2009. And second of all, a 10-year projection isn't worth the paper it's written on, right? And I mean, the fact that anybody is really debating this, when you look at the underlying fundamentals, it's just nuts. And we don't even need to get into the fact that they've got no IP, right? The whole story is everybody loves this product. McDonald's and Burger King if this really takes off and it's a trend, do you think McDonald's and Burger King are going to keep buying that from them? No way. They're gonna develop it on their own. I mean, it's a poster child for the price insensitive insanity that we see all along. But other than that, I'm really bullish the stock market.
I'm feeling so much conflict there, but anyway.
Yeah.
So how high do you think this insanity goes on Beyond Meat? I mean, are we going parabolic here, where it first goes to 300? Because me and Kev are going to be talking about this a little bit later on from the options perspective. But what is this? How crazy does crazy get here? I mean, do you think that this still can pull a Chipotle and just keep ripping to 300, 400, 500? Not based on many valuations. Clearly, you can't justify that. But we're just talking about pure momentum of the animal spirits of insanity. I guess you can put it there.
Yeah. Well, I really don't. I feel like it's going to go higher. I mean, that's just kind of my gut. I feel like that's kind of the same with the market. And we have a joke around the office that it's sort of like traveling to the moon, right? Whether you're off 1 degree or 20, the result's the same. And so, what prevents? Why not 400? Why not 5? I mean, why not? I can't even begin to get my head around the valuation. So my initial response is higher, right? Look at Shopify, for God's sake. I mean, why not?
Be careful now. That's a good Canadian company.
Yeah, go ahead.
But you know what's interesting is that Beyond Meat just passed the market capitalization of Campbell's Soup, right? But did. It's now got a higher market cap
or something like that. It's not been around very long. It's an unproven concept.
Yeah. There was a fascinating one that I put out the other day that I kind of ran across, and I just thought it was incredible. So last year, Kirkland Signature Brands, right? Costco's proprietary brand. They sold They did $45 billion in revenue through Kirkland Signature Brands alone, right? Last year, Beyond Meat did 95. I want to say this year they're slated to do like 120 million in revenue. And then you start comparing that kind of valuation. You look at what that kind of valuation they're throwing on Beyond Meat and what people are projecting out here. And again, it's not a like for like comparison, but at least to me, it provides scale. And it's just shocking. I mean, do they think that Beyond Meat? Because if you're buying it here, you have to be, right? You've got to be thinking that it's going to be on par with like a Kirkland Signature or something like that.
Yeah, for sure.
And it just defies logic.
Okay, so I want to interrupt here and talk a little bit about what you're seeing on your retail clients. Like you're actually talking to retail clients and you're seeing the pressures they face in terms of saving. Are you finding that they're chasing stocks up here, or do you find that they're kind of wanting to like step back and say, I want to sell? Like what are you seeing on the retail side?
So there's so much, and I don't doubt the data, and I think a lot of the guys that are putting out this, I respect it. If you guys know, if you do this long enough, you learn to really respect anybody's opinion, because God knows, right? Anybody can, but there's all this talk about all these withdrawals from mutual funds. I don't know what's causing that. What I do know is that I've been doing this now for 13 years, and I have never seen retail investors as bullish as they have been in the last 6 months. It was kind of like that
Really?
last year 100%. They want pedal to the metal. And it's like that last blip we had at the end of 2018 there was the straw that broke the camel's back, and they feel bulletproof. And we've been lucky enough to have some great investors that came to us. We don't make any bones about our approach. We come right out in front and say, look, we're all about achieving your retirement goals and not chasing performance. And, we think that there's some big issues. So, but I think anecdotally, this is a perfect example. A new client of ours came on in October 26th of last year. The reason I know that is because I went back and looked at it because it blew my mind. He transferred over. We liquidated everything he had. And I looked at him and I called him up and said, listen, if you want to watch your account, you can, but I'm going to leave you in cash because I don't like where we're at right now. And I just don't feel like it makes sense to put you in here. So he was 100% in cash from October 26th to the end of the year. Okay. We redeployed his money February 1st. He left us on February 26th because we weren't aggressive enough. Now, over that period of time, he outperformed the S&P by 13%. Yeah. And we weren't aggressive enough. And that just typifies what I'm seeing everywhere. That's just one anecdotal story, but I'm seeing it everywhere. It's really amazing.
Well, okay, so we're gonna have to wrap up here. Before we do that, why don't people tell people where they can find you, what you do, and where they can catch your radio/podcast, because it's a definite must listen. And I really, after you listen to the Huddle, of course, you should go and listen to Know Your Risk Radio. So Zach, why don't you tell people where they can find you?
Yeah, so you can find us on Twitter at KYR Radio. And then you can go to our website, Bulwark Capital Management, bulwarkcapitalmgmt.com. You can also just Google Know Your Risk Radio. That'll connect you to the radio show website, which links to our main site. And then I think we've got a link on our site to get to our Apple or iTunes page. But I think the easiest way to find our podcast is with just Googling Know Your Risk Radio Stitcher. And we've had Kevin on a bunch of times. We're releasing a show with Jesse tomorrow. We've had Bill Fleckenstein and Luke Roman and Brent Johnson. And it's been, and I'm sure you guys can agree, certainly Patrick doing macro voices as well. One of the coolest things about it is just getting a chance to meet and talk to these guys. And I think there's some good stuff on there.
Okay, well, great. It's been a pleasure having you on, but we're not going to let you off so easily. We're now going to go on to our tales from the trading desk. And being a man of the markets, I figure you might have one or two to tell us. So why don't you shoot away, Zach, and tell us a tale?
Okay, I got a couple for you. First of all, I think you guys will get a kick out of this. I started at Russell Investments right out of college, a mutual fund management company, and got recruited to be a broker. And this isn't a trade, but it'll just kind of tell you why you should take everything I say with a grain of salt, because my timing has not been ideal. My first day starting at brokerage was September 15th, 2008, the day Lehman went under. Yeah, I walked into the office and by midday the guys were looking at me like Jonah. They wanted to throw me overboard to stop the storm. They were like, this guy's a bad omen. And one of my favorite trades that I didn't personally execute, but I saw, it's one of my favorite, and it's also one of the most heartbreaking I've ever seen, was again, on the retail side, you see all walks of life. And so when we got in there, maybe it was when I was interviewing, because that was a little bit late in the game, but my boss who hired me, he'd been in the game for a long time, the branch manager, he had a client that was an old lumberjack. The guy was probably 60 years old, and we're in Seattle. So everybody thinks of us now as kind of techie, but we have this big, mountain man mix of people. And he fit the bill. He's got the flannel shirt and the suspenders and big beard. He's got about a $50,000 account. And it must have been that summer when I was interviewing, but I was there when he came in, and he wanted to buy E-mini puts on the S&P because he was convinced the whole world was going to come apart. by the time I got started in the height of the breakdown, I want to say it was in December, January, maybe even latest February, his $50,000 account was up to 2.5 mil.
Wow.
And yeah,
The lumberjack knew how to
was,
trade, man. That guy knew how to trade.
Well, gamble is more accurate, but
yeah, right.
As a Patrick, as opposed to you and I who trade and everybody else gambles, buddy. I think the guy knew how to trade. Anyway.
This wasn't exactly a Patrick Ceresna approved option strategy, that's for sure. But so then he goes on vacation, right? Because he's rich. So he's in Hawaii, and we're calling him nonstop. I mean, it was really close to the bottom.
Yeah.
And we're calling him nonstop, begging him to sell. And he goes, "Nope, this is just the beginning." Anyway, the guy. He finally covers when his position's worth like 110 grand.
Oh, that is a heartbreaker. So he wasn't a trader after all. So what he thought when the S&P was 666, he thought that it was going all the way to zero?
Well, yeah, it's a demonic omen, man.
Yeah,
I met zero, right?
So Patrick, I finally met somebody that's more bearish than you, buddy. The lumberjack.
But he should have just rolled it out and down, right? But anyway.
We tried to present all these different strategies. He just wouldn't listen. He had it right. And after all, he's the guy that rode the account from 50,000 to 2.5 million. So what did we know?
Yeah. Well, that's a great story. Thanks for sharing with us. And for those who want to hear more of Zach, make sure you stick around for the after hours when we'll get into more of these great stories. Thanks again, Zach.
Oh, it's a pleasure, guys.
All right, Kev. Time to move on to what we thought was something important to talk about, and you wanted to talk about Beyond Meat and the options chain, which I'm finding fascinating. Let's get right into it.
Well, a lot of people have been kind of highlighting the fact that there's a huge borrow cost on Beyond Meat, and obviously, if you don't know, Beyond Meat is the the kind of poster child of this bull market rally. What started out as a $40 stock when it came out as an IPO has quickly zoomed up to $232. It's been just insane. I think it has a bigger market cap now than all of Molson or whoever owns Molson. I can't remember. It's the big brewery and stuff. And it's just been insane. Like the market cap of this thing has gone nuts. And one of the things that's happened is people that have been trying to short this thing have had their face ripped off, like just ripped off. And not only are you getting your face ripped off with the reality that this thing's doubling every single week, the other problem is that there's a borrow, and there is a monster borrow, and it's roughly when we pull it up on IB right now, they're showing what 130%.
Yeah, it was at one point 136. I think even at one point it was like 144% or something. Like it's fluctuating, but it's right up there. It's crazy.
So what that means is that if you're short the stock, you're actually going to be paying that amount out over the course of a year. That's an annualized figure. So you basically have to, if you're trying to short that, you need it to go down faster than that rate. And that's pretty hard, right? So it ends up being very difficult to be short this stock. Your timing has to be perfect. But one of the things that people say is, well, maybe I can go trade the options. And so I thought I'd pull it up here, and we're going to talk a little bit about put-call parity and what happens when we get a situation where you get a stock that has this high of a borrow. Yeah. So if we go pull up like the S&P, we do the spiders. The spiders are right now around 301.67. Let's call it 301.70. If you do a September option, and we're going to just choose September kind of arbitrarily, but that's 56 days until September 19th or September 20th of 2019. If you go look at the calls, they're $1.50 in the money, and the calls for the S&P, these $300 calls would be trading around $6.90. And then the put would be trading around $4.70. That seems kind of fair. And, you think about it, the calls are $1.50 in the money. They should be more. Yeah. And it seems like that makes sense.
A slight probability adjustment as well.
Well, no, there's no... because
one is actually... Anyway, don't worry.
Yeah.
Let's
it's not... you should be able to go and buy the put... buy the call, short the stock, and buy the put, and those three positions should equal each other, and you should be flat. So that's basically
less interest, right?
Right, and that's the key, is it's less interest. Now, when you go look at the options for Beyond Meat, and we're going to pull up something that's the same one, the September of 2019, so 56 days from now. If we go see, the stock is trading, when we did this, it was trading around $237. And we see that the 235 calls, which were basically $2 in the money, were trading for around $25. Okay. Then we look at the 235 puts, which are out of the money by $2, and they're basically $53.
Yeah.
And you might think, well,
that's only 56 days. That's
right. And you might think to yourself that this is a situation where this is the market trying to think that everybody is bearish, and that is why the put is so expensive versus the call. But if you think about it logically, you can create a synthetic put by going out and buying a call and shorting stock, which is why put-call parity exists. So when you pull up the option chain, let's go to the next page here, Patrick, and you go look at your Bloomberg or whatever charting package you're using, or not charting, option pricing package, you'll notice that the bid offers on the implied volatilities are actually the same, even though the one is $30 more. Mm-hmm. And it's because implicit in there is the cost of that borrow.
Yeah.
So when we go look at the 235s, you'll see that they're showing on this, at this particular point, it was 2120 bid at 24.5 offered. That showed a 95 vol bid at a 105 vol offer. Then we go over and we look at the 235 put, and we see that it is $55 bid and 57.5 offered, and you'll see that it's roughly the same as 105 vol bid at 115. Now, every kind of person or every entity has a different cost to borrow, and different people have different abilities to borrow that stock. So this is where arbitrage comes into account. Right. Because if you can get a better a better rate to borrow that stock at, you can go and lock in a profit by whatever the implicit kind of borrow fee is on the options by creating a synthetic long.
Right.
Do you see what I'm saying? And
yeah,
so
absolutely.
One of these things is that you have to be aware that it's not the market thinking that they're more bearish on Beyond Meat, because if we remember back, this is an important part. You can make a synthetic put by being long the call and short the stock. There is no different. Like if you're sitting there and you're a market maker, or a professional trader, and you have access to a borrow, then it doesn't matter if you have that kind of long call short stock position, or you're just long the put.
Exactly. And what's interesting is that this actually creates some interesting opportunities. And one of the things that I like, let's build a scenario, because obviously if you don't view this scenario, then it's not a good trade. But let's say one was saying, look, this thing is just in parabolic mode, and like going back to that chart, let's say you had the hypothetical view that Beyond Meat during this parabolic phase can blow to 300 or even higher. And just can keep going, because I mean anything that can go from $60 to $240 in a couple months can go from 240 to 300 just as easily, right? And so somebody that, let's say, wants to get onto this easy money train, at least it always appears that way until you're on the wrong side of the trade, then you want to buy it and participate in the upside. But how do you manage that risk? Well, what's interesting is that right now, like I don't have the quote in front of me, but when we were looking at it, you could right now buy a 235 call option, let's say out till September, for let's say $25. And out to September, you could sell, let's say, $140 put for $25 income because of that carry, not carry, but the interest being put in there for the borrow. And so you actually can be in a scenario where for a zero cost, because the $25 you collect as income at 140 paid for the 235 call. And you basically have all of the upside above 235 for the obligation to own the stock at 140. Now, if you think the risk is that's going back to 80 or 60, well, then the 140 obligation is still a pretty good losing proposition. But if you think that between now and September, the stock can stay above 140 and that this thing could still rip to 300, this makes it a really interesting way at a very low cost to actually keep playing the upside due to that short interest that you're earning on it, right?
Right. So you're trying to find a way to harvest and take advantage of the fact that that short
Exactly.
interest is so expensive. And so
Right.
you're doing it by kind of, let's say, I'm going to buy a call and I'm going to sell a put to finance it. Whereas that would usually be kind of an expensive proposition.
Yeah.
Or not expensive, but it wouldn't be such a winning proposition. The fact of the borrow makes that much more interesting, because back to our idea that if you think about it costing 140% or something borrow fee, that means that if it declines, it has to decline faster than that for you to make money.
Yeah.
So think about that. If we're short and so the stock's what, 235? Is that what you said? And we said that it's 140. Is that what the borrow fee is? Let's just say it's 140. That means that every single day, it kind of decays 90%, 90 cents in your favor. So that means that in a week's time, if the stock you're short and it hasn't gone down $6.30, you've lost money on that position.
Yeah.
And so this is why these kind of situations where you get a huge borrow fee, and I don't know if I've ever seen one like this. Is getting pretty excessive. This is getting right up there in terms of the biggest ones out there.
Have you? Yeah, like I've never seen this.
I've seen lots in this range. I don't know if I've seen anything in the 200. I can't remember anything with a 200 handle except for little spikes.
Yeah.
But this is a pretty big stock to be at 140%. This is good, but you just have to remember that there's no free lunch out there. So you think to yourself, there's a huge borrow fee. I'm going to go buy puts. Well, no, that's already in the market.
Yeah, yeah.
And that's what you need to understand is that is all gets arbitraged out. There's no free lunch, and that is all getting priced correctly. Just go have a look at put call parity between Beyond Meat and just compare it to something that has an easy borrow like SPYs, and you'll instantly see what it means. And for those that are interested in option pricing theory, it's a great example.
Well, thanks for sharing, Kev. I think this is just fascinating. It's certainly something that I'm going to keep an eye on for sure. All right. Let's move on.
This week in trading history, your favorite topic. What do you got for us this
I've
week, Patrick?
I've taken over this because I have no skill whatsoever to create WTF videos, so I have to do something.
I think it was more that I was so lazy, and you were just like, I better do it because he's not going to do it. But anyways, what do you got for us this week? You're so good at it.
All right. Well, we're going back to July 25th of 1893 and to the low point of the Panic of 1893. And when I started doing the homework on this, I was like, I could not believe how much history rhymes.
Oh, yeah.
Like this is fascinating story. And so let's get it right into it. So number one, until the Great Depression happened, it was considered the worst depression in the United States that they've ever experienced. And so it took the Great Depression and and it's amazing how we usually stop at the Great Depression and don't go any further back. But just going back 125, 130 years, there was what was a really Great Depression, and very few people know about it or understand it anyway. And the panic was marked by a collapse of railroad overbuilding and shaky railroad financing, which set off a whole series of bank failures. Compounding that was that the market was overbuilding the railroad bubble burst, and there was a huge run on the gold supply relative to silver, because back then the Sherman Act, which I want to save for actually another session, but there was a huge run on the gold supply. So let's kind of work first of all what happened prior to this in order to build it up. So it was in the 1880s was a period of remarkable economic expansion in the United States, an expansion that eventually became driven by huge railroad speculation. And obviously, just a few episodes ago, we were talking about the transport index, but Charles Dow and Schwab, not Schwab, sorry. Edward Jones basically put together the transport index because of the bubble in these transports. Right. This is why this happened. They put it together in 1884. It was because there was this massive boom in railroads, and they wanted to track this build of the railroads. And so there was a huge overbuild, and back then M&A activity was huge. Everyone taking all the different railroads, doing all this crazy financing to take over its competitors, and it endangered their own stability. It was just a huge boom, very much like what we see in different sectors in today's markets. But what's interesting is the farmers, particularly in the Midwest, were suffering during this period. Particularly, they suffered from a series of massive droughts, which left them short of cash to pay their debts, which drove their down the value of their land and created a huge rout of bankruptcies in the farming space during that period. And so what ended up happening, it was in 1890, the Sherman Silver Purchase Act was passed. And I'm not going to go into detail because actually it was such a fascinating story, so I have to save it for a separate This Week in History. So I'm not going to get into detail there. We'll save it for another one. But what was interesting was the farmers had immense amounts of debts that could not be paid off due to the deflation that was occurring because they were on a gold standard. And so they urged the passing of the Sherman Purchase Act in order to boost the economy and cause inflation to allow them to pay off their debts in cheaper dollars. Wow, like you go back then, and even back then they understood the concept of inflation and how money supply and all of these different things and paying off debts with cheaper dollars. I mean, it's not just a modern thing. This was going on back then, right?
Patrick, inflating away your debts is as old as time.
Yes, you're right.
It's only you deflationists that think that it's never going to happen today.
Okay. Anyway, to be continued. So one of the first signs of trouble was the bankruptcy of the Philadelphia and Reading Railroad, which had greatly overextended itself. And in February of 1893, 10 days before Grover Cleveland's second inauguration, upon being named president, he basically dealt with the Treasury crisis by basically repealing this Sherman Silver Act, which he at the time felt was responsible for the crisis. So that Sherman Act was enacted 3 years earlier, and then as it came into the crisis, it repelled it. But what happened was that the concern of the state of the economy worsened. People rushed to withdraw their money from the banks because the fear that there would be all of this repercussions from doing this, and it caused a massive bank run. And everyone basically thought that the banks were going to go under, so they all made the bank run, and it caused this massive credit crunch that rippled through the whole economy. To exacerbate this, there was at the same time in London a financial panic in the United Kingdom, and a massive drop in trade with Europe that caused foreign investors to have to sell these American stocks to obtain American funds that were backed by gold at the time. And so it was just a massive, self-feeding loop. And what's interesting is that the investments during the time of the panic were heavily financed through bond issuance with high interest payments. And one of those companies, the most actively traded stock at the time, was the National Cordage Company that went into receivership as a result of all these banks calling in their loans as a response to the rumors of financial distress, but also because they were having bank runs on their end. And so they're calling in the loans. And the company, which at the time was cornering the market for importing hemp, basically imploded. And so at the time, the demand for silver and silver notes also fell in value, and the holders were worried about the loss of the face value of their bonds, of which were rightfully so. Many of those bonds became completely worthless on that front. And so this led to a series of bank failures that followed. Northern Pacific Railway went under. Union Pacific Railroad went under. The Atchison, the Topeka and the Santa Fe railroads failed. You had massive bankruptcies that followed. Get this, a total of 15,000 companies failed that year, including 500 banks in the West. So you had a scenario where, according to estimates, the unemployment hit near like 17 to 19% of the workforce. The unemployment led to panics. There was huge spike in that. Many people's life savings were completely wiped out as all these bank failures left the middle class completely broke. And many of them couldn't meet their mortgage obligations and walked away from their recently built homes. It just like became one massive gong show.
But think about from an Austrian perspective how awesome this was. It cleansed out the system.
Yeah. Hard money rules. So
hard money. It's a good thing. It's a good thing.
One other interesting echo that is worth kind of looking at from history. While it didn't, I don't know how much it contributed to the panic itself, but what was amazing was that during this panic was when in the United States there was a huge populist movement by the People's Party. And it was a agrarian populist party that basically rose to power on the left-wing side and drew huge support from angry farmers in the West and from the South. And guess what? They were critical of capitalism, of banking, of railroads, and they completely allied themselves with the labor movement at the time. And so at their peak, a year before the crisis in 1892, they were on the ticket for the presidential elections and won like 8.5% of the popular vote and took like 5 states at the time. And so it was a huge movement. And again, it was these populists crusading against the hostility of elites, of cities, of banks, of railroads, and the use of gold. And so you had this huge angry movement at the same time as this crisis. And so it's amazing how we see such a populist movement today, and you can go back at the time for a little bit of history of when that actually was happening.
For sure, it's a great story.
Yeah.
You know, Patrick, I have to say one thing.
Okay, tell me.
As anyone that listens to us knows that we both mess up words all the time, and
which one did I mess up?
Well, so first of all, I'm basically Billy Joel in front of a glass house. I should not be saying this. But
all right, make fun of me. No, make fun of me. What did I pronounce wrong?
So, Grover Cleveland. He's a funky dude. Is he Grover?
Grover?
Yeah, you said Grover. I was like, okay, let's go with Grover Cleveland.
I need another beer.
Okay, Grover Cleveland. Okay, so listen, where else will you find listen a little bit of financial history and finding out what Grover Cleveland was up to 100 years ago? Thanks a lot, Patrick.
All right, so let's go on to the WTF clip of the week.
Okay,
all right, what do you got for us?
So this one was, I saw John Chambers, the former famous Cisco CEO, was on CNBC recently, and he talked about the fact that he thought that tech was going through a midlife crisis. And I thought, you know what, I got to do a WTF clip on a midlife crisis, and I went back and forth, and I couldn't really find a good movie to kind of mash it with, and finally I decided to go with This Is 40, which is that Judd Apatow movie, and I thought it was a good little mix-up. So here we go. Here's John Chambers talking about tech's midlife crisis, along with a little bit of This Is 40.
Midlife crisis, and are all big tech companies in the same phase?
Why does it say 38 and not 40?
Because your mom wants to be 38. Let's not mention it again.
On your form, you said you were born in 1974, but your paper, it said 72.
It's 1974.
Oh, wait. On your last form, you said that you were born in 1975.
No, I think what you see is any company goes through periods of transition.
We're 40 years old. If we don't do it now, when are we going to do it?
Your eyes are kind of glazing over.
No, I'm processing it all.
Jack Welch taught me many years ago, you'll never have a great company till you have a near-death experience.
We have to get more involved in school.
Your son said some offensive things about my daughter.
Oh, really? You better get her meds right.
Excuse me? Your kid is an animal. He insults my daughter again. He'll be so sorry.
You touched my nipple.
I got right below your shoulder.
I have very high nipples.
and that is true. And Cisco saw it in 2001. But what you are seeing, however, is very concerning.
Sorry if I'm not all fancy pants and wealthy and showing it all off with my Vidal Sassoon haircuts. Sorry. Quit slow blinking at me.
I'm sorry.
Okay.
I would like to rear up and jackknife my legs and kick you both in the fucking jaw with my foot bone. That's what I would fucking love.
If the major tech companies don't focus on tech for good and a balance between traditional capitalism, if you will, and a social obligation to society on creating jobs, etc., there are going to be a lot of challenges, the most recent being privacy.
I wish my fucking foot would go right through your skull. This is what happens when you corner a rat. I will fucking kill you. You corner me, I will fucking chew through you. I'll chew through you. Slow blinking eyes. I will chew off your fucking eyelids. You won't slow blink at me, will you?
And this is where the companies must get ahead of the regulators and lawmakers. If you really think about it, their currency is very simple. It's track record. It's the relationships, both with people and with the citizens, and it's trust. And
did you drink before you came here? No, but I'm going to start drinking. I'm going to slit somebody open like a fish and drink their blood. That's what I'm going to drink if we don't start getting to the fucking point here. Probably I'm going to start with Karen Carpenter's head. I'm going to rip her head off, and I'm going to drink her blood.
Now, John, you've said that Jeff Bezos of Amazon has done the best job of growing the business amid all the scrutiny. How much of this has to do with a different business model, or are there any lessons that perhaps Mark Zuckerberg could learn from how Jeff Bezos has been handling it? And to me, it seems like he's just been avoiding it because he hasn't had the same level of scrutiny.
And then I'm going to come back and light you on fire. I'm going to light you all on fire, but I'm going to start with you, Jill. I'm going to fucking torch you. And I'm going to string it around all three of your fucking necks and then drive around town dragging you. That's what I'm going to fucking do.
That's completely uncalled for.
Really, Jill? Do you think it is? Fuck off, Jill. God, everybody fucking hates you.
Well, you know, it's several comments. First, if you really watch about Amazon and what Jeff has done, Jeff has built an amazingly powerful company. He clearly leads in so many different segments of the industry. His challenge will be different, I think.
That's totally uncalled for,
You're
Catherine.
a fucking asshole. Everybody hates you. They hate your fucking Bob. And I'm glad your husband died. Because you're a fucking asshole. He probably killed himself. I would. I'd kill myself. God, I'd kill myself, Jill.
I'm gonna jackknife my foot right into your head, Kev. That's what was gonna happen at the Huddle until.
That's right. She is so funny, isn't she? And that was just like an hilarious kind of outtake. For those who don't know, that was actually not put in the movie, and it was just kind of hilarious how the two actors that were sitting beside her couldn't keep themselves from laughing as she went on and on and on about all these terrible things she was going to do to her. But you know what was interesting? I thought it was, John Chambers was funny how he's talking about tech going through a midlife crisis. What do you see? I see Facebook, and I notice that it's pushing back up to the highs, and I'm not so sure he's right. Like, is it really something that we should be worried about? Are these kind of FANG stocks suffering from this midlife crisis that he says? Like, what do you think?
I don't. You know what? Right now, the market is the market is back into buy mode. And because these are such huge market cap behemoths, they're getting their fair share of the money flow that's coming in there. And just right now, obviously, Google just beat before we did, and they had a monstrous gap higher. Like, look at that move in Google. Like, all these techs are getting their buying. You know what? Like, they are going. I think that it's a much bigger thing than whether or not you are positive on your returns in the next month on tech. I think his point that he was trying to make was more about the political pushback that they're going to continue getting in the years to come. Right?
Could be. I don't know. John Chambers kind of lost me on a lot of things, so there we go. I'm gonna leave it at that. I'm not sure if he's correct or not. It made I thought a good WTF, and it was always a pleasure to have Melissa McCarthy included in our WTF.
All right, let's move on. Kev, it's time to review the top 5 things from last week first, before we move on to the next week. And we actually had 6 things that we wanted to review. And number 6 was that there was no such thing as a bad tick. And obviously we touched on a lot of the pound closing the bad tick, but the Japanese yen still hasn't got that tick. Well, let me flip this upside down before you yell at me. There you go. But
I don't yell.
Before you shame me. Okay. We have it kind of rolling up. It just doesn't want to finish that to make you look.
Listen, it doesn't occur right away. You just have to remember there's no such thing as a bad tick. It takes a little while.
Because after a decade, eventually that price point might be hit, and even a broken clock is right twice a day. How many years does this have to take to gap fill for you to still take credit for it? Like if 3 years from now it touches, then you'll say, oh, no bad tick. See, 3 years later.
How does that differ from the majority of hedge funds and Twitter guys?
Okay, I guess so.
Okay.
Anyway,
let's go on.
Number
5.
It's not happening, dude. Anyway, so what's going on commodities, right? So interestingly enough, so we covered a few of them. I still like the OJ, buddy. The orange juice. Like, dude, you know what? I have a feeling this is going higher. It's winding up, but you know what? I feel like, to do a junior technician's trend line.
So unbecoming of you, since you're a senior technician. Anyways, go on.
So a breakout of this range on the upside might send orange juice futures moving. I'm excited about it. Anyway, so what are the
no, wait, whoa, I got to talk to you. I'm seeing your junior technician trend line there, and I've seen also you could make one in the bottom. So put your line back on there. Your squiggly.
Well,
it's back on.
Okay, so you're basically it's a horizontal triangle.
Yeah. So what happens when that just keeps going sideways? What do you guys do? Like, is that like crossing the streams and?
It can't. Oh, like God forbid it does this, right?
Yeah, it'll just mess you guys up.
What? No, because then we get to redraw the lines, right? So
that's right.
Then I would be like, no, this is actually the,
At least you're honest about that. Okay, let's go on. I'm with you. I if I had to choose up or down, I'd definitely choose up on the
All right, so
OJ.
corn keeps consolidating. I don't know.
I think it's more than consolidating. I think it's trading like shit, and I'm actually a little worried about it.
Yeah, why? I mean, what is there? Is the harvest going to be better than you think? Like
I have no idea. I'm the world. Listen, I want to be long these things. I have a feeling that one day we're going to wake up and they're going to double, but I'm so wrong on all these. And not only that, let's have a look at some of the other
You know what? To be honest, this is a blessing. I'm going to stay long corn. You get out. Because the problem with corn is that we were both long at the same time.
We gooch it.
And so if you move to the sideline, you'll do me a great favor.
Take one for the market gods. Okay, so listen, go pull up like the other softs. Pull up cotton. Like, there's some real problems occurring in some of these. That looks like crap. What other
lumber?
So lumber is not that's not so bad. But we can go through sugar. I think looks like shit. Like we have some real problems with commodities, and if we don't get them off the mat, then it's going to be a sign that there's not enough liquidity in the system, and I think it's a big deal. So I hope you're right.
And plus it'll make it hard for your inflation boogeyman to show up.
For sure will. Okay, let's go on.
So by the way, just very quickly, crude still very weak, and gold not able to make the breakout. It prairie dogged a little bit up to the top.
It did. And a noble animal.
Noble animal, and has not yet been able to. So right now commodities are still muddled. I'm cautiously bullish, but let's see. So we had the earnings of Amazon
and Boeing.
Right? And Amazon gapping a little bit lower. I mean, I wouldn't call that extraordinarily.
It's not a big deal.
At least not from its past ranges. It's not like a huge breakdown like Netflix had. But then Boeing had a pretty solid breakdown on its earnings as well, right?
We've been pretty negative on that, thinking that that's going nowhere for the while.
I still think we'll see 300 on Boeing.
You're still bearish? You still think it's headed lower?
I mean, look, it traded at 300 at the start of the year. I mean, it's that was before the all of this crazy airplane crashes and groundings and everything. For it to trade at the same level it traded at the start of the year is not a stretch, dude.
Yeah. No, I'm not disagreeing. I just think I'm neither that bearish nor that bullish. I think it just meanders sideways to lower.
Anyway, we touched on oil when we were talking commodities. I mean, in the end, energy is still in the gutter. But number 2, we were talking about the ECB, and obviously...
Okay, well, let's start with the second part of that, the European PMIs. Let's just start with that.
Sure.
They were ugly. Like, so ugly. Like, you pull up the German manufacturing PMI, it was 43 or something, like full-on contraction territory, not looking good. Dogs and cats living together. This is a real problem, right?
Like here's your chart right here.
Right.
Now, 43.1.
The interesting thing is that everybody's pointing to this chart telling you why you should sell everything because of this. Now, I agree. It's shit. No doubt about it. It was 60 a year ago. If you were like...
You calling the bottom, dude? Are you right now calling the bottom?
I am.
Oh, my God.
And now we'll go on to the next part of the ECB press conference. What did Mario say?
They're going to keep juicing it.
Well, first of all, it doesn't matter. If they keep juicing it, it's not going to help the economy. So, just put that aside for a second. More monetary stimulus is going to do nothing. Nothing. You could go and you could double your monetary stimulus and it's not going to help the economy. It's going to do nothing.
You mean going from minus 0.5% interest rates to minus 1% won't stimulate it?
Yeah. It's going to do nothing. It's going to hurt. So just ignore all that and just think to yourself, I don't care about monetary. All I care about is whether we're getting closer to the point where they're going to do fiscal.
Yeah.
And he outright said it.
He did, eh?
Go watch what he said. He said it. It's coming, man. The world is changing. They're understanding that they cannot do it through monetary means, and we're getting closer and closer to the point where we are going to be doing massive fiscal, and then we're going to be shocked that we thought we couldn't create inflation. Like, it's just they're mouthing words still about doing, supporting the market through their monetary means and blah, 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 blah. Ignore it. It doesn't matter. Honestly, it doesn't matter. It won't help. It won't do anything.
Their stock market is now, the Euro stock is actually a stone's throw away from its major highs. And their bond market's at record highs. So their asset prices, this is not like the end of a bear market where assets are super cheap.
Come on. Come on. Pull up the Euro stocks and go back it out a long way. Back it out to 2000.
Okay, yeah. So it's been dogging it. Hold on, I'll pull it up.
Dogging it is not the right word. Right, it's been like tiny little schnauzer dog that's yipping away. It's really in the doghouse.
Yeah.
Can you pull it up?
Yeah, right here. So there's here.
Just go back. So you're worried about it. Oh yeah, no. Can you go back to 2000? Let's see.
That's 99.
Yeah. Okay. So you're worried that it's risen from 3,000 to 3,500. We were at 5,400 in 2000.
Yeah.
Put the S&P beside this and have a look. This is
that's true. You're right.
It's the reality is that the European stock market. Now, if they continue to do their stupidity of putting more monetary stimulus with fiscal austerity, then it's going to stay here, and we're going to wake up 10 years from now and it's not going to have moved, and it might even be lower. But if we get a situation where they actually change their prescription and they start doing more fiscal, and in fact,
are you trading? Are you going to go long Europe against short S&P?
I would do that trade right now. Yes. For the first time, and I'll tell you why. Because I think that there's a chance that Lagarde is going to be the agent that brings that in. Now, everyone will tell me, "Oh no, she can't do anything." Blah 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 blah. Well, you're right. Maybe they're right. But what if there's like a 1 in 5 chance that she is? What if there's a 1 in 5 chance that she's correct? What's going to happen to these assets? They're going to have to reprice because right now there is 0% chance priced into that. All that is priced in right now is more and more monetary stimulus with less and less fiscal, more fiscal austerity. And if you start to think that they might be switching, then even if they don't switch, but just the simple fact that they think about switching, you might get a situation where these things run and they run for a while because they're cheap and the BYND is stupid. So I'm started to put that trade on again. I'm short BYNDs. I'm long, Euro stocks. I'm probably wrong. I'm alone. I'm the only guy that's kind of talking about it that'll admit that I'm short BYNDs. But I like the trade. I like the trade.
You heard it from Kevin Muir here first.
But back to the PMIs. 1 second. Sorry. I know we're going on long here about this, but the PMIs. Yes, in 2007, when the PMIs had collapsed this much, the stock market still had more downside to come. I will not deny that in one bit. But if you go back and look throughout history, usually when the PMIs hit this sort of depressed level, it is not time to sell stocks and buy bonds. This is usually the point where it's all baked in and you should be going the other way. And I really think that that's what we got here. Everybody remembers 2007. Everyone's trading on that playbook. They're trading on the wrong playbook. That is not the playbook to look. You heard it from me.
I like it, Kev. I like it. I love it. Love it. All right. So let's talk.
You love it as you go and take the other side of my trades. Okay.
I will.
US.
I will.
Okay. So again, Patrick, we talked about this. You think the economy stinks, is terrible, blah, 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 blah. I hear it all the time. I'm amazed. We just printed 2.1, 0.3% higher than the survey.
Yeah.
And yet we still have like 3, cuts priced into the next year. The hedgies and all the guys, the JP Morgan guys of the world all think we're going to 0 on the 10-year. And
me included.
Yeah. And here we are printing 2.1.
Yeah. But I mean, this is actually not, in my mind, a big shocker, because I continue to believe that the U.S. economy will be the last one of the global economy to fall into a recession, and so to me, the fact that this is lasting longer is not a big surprise. But I still think we're going to have negative GDP. I do. I think we're having a recession. We'll see.
Well, I'm sure we're going to have a recession. It's just the question is, are we going to cut 3 times into this and cause, your worry might cause the Fed to panic and ensure that you guys never achieve what you're worried about?
So are you in that camp that we can avoid ever having a recession so long as we panic and are proactive beforehand and they juice it up just before a recession's about to occur, and therefore we could always avoid a recession and we can never have one if it's managed right? No. Because
I do think though, Patrick, that we have more recessions than we need, and they occur more often than we need.
Oh my God!
I know. That's terrible.
Oh my God! This is terrible.
I get it.
I just vomited a little bit in my mouth.
All you guys think that somehow this is a good thing to put people out of work. Oh, great! Let's put all these people out of work and stuff. I look at Australia. Australia had 25 years without a recession. I think we can do a lot better than we do, and I think the problem is that we don't understand how the economy really works. But that doesn't matter. You know what? What I think doesn't matter, because it's it doesn't help your P&L whether you believe something. It's whether you can predict what's going to happen. So put aside what you think is going to, what you believe we could do if we did the XYZ. The question is, what are we going to do? Mm-hmm. And that's all that matters. Anyways, let's go on. Okay, Patrick, time for the top 5 things to watch next week. What's number 5? Hopefully we got down to 5 this time.
We got it down to 5. Chipotle. Right? What first of all, this stock is a very, very special stock. I mean, this thing, the growth cycle the growth phase that it went through in the last decade has been nuts, right?
Patrick, you said first of all, and I thought you were going to say, how good are their bowls?
Their bowls are pretty good.
Yeah. Are you a fan? Let's talk about the important stuff first.
I love burritos.
Yeah. It's great stuff. It's great stuff. You know what? Don't worry about the salmonella poisoning or whatever it is.
No. You know what? You got to roll the dice. You know,
Exactly.
You can
man,
walk.
that's
You
how
can
I
walk
feel.
out on the street and get hit by a car tomorrow. You know, I'm in. When I need my burrito, I need my burrito.
You know what? When there's a big scare and somebody gets poisoned, that's the day I go because I know there's gonna be less line. Although you would expect nothing less from the contrarian, right?
No shit.
Yeah, like there's like when it hits the headlines, and I'm like, okay, let's go. There's gonna be no line at Chipotle. Let's go. Okay, let's back to the stock.
Funny.
Sorry.
So, but like this thing from 2009 lows to 2015-16 had an epic run from like $40 a share to like 800. It was one epic run, and then obviously came the whole little scare, and the thing wipes out from like basically $800 down to 250. Just completely killed, and that was proved to have been an epic buy on dip. I mean, the thing went from $250 almost back to 800 again. I mean, we're at 778 right now.
And do you know who bought that? Do you know who bought that dip, Patrick?
Carl Icahn? Who? I don't know.
No, the other guy, Bill Ackman.
Really?
Yeah.
Well, he needed a comeback. He needed a comeback. If there's one guy that needed a comeback, it was him.
Yeah, that guy likes to roll the dice. He was in there. He bought it, and I see that his fund. This is like an article from February, but he was up 24% in the first 2 months of the year because of Chipotle.
Wow.
This guy's just like he's got it all. Like
he sizes his trade with serious conviction, right? Like he doesn't mess around with a diversified portfolio.
Although I do see that he's been peeling some off into this rally, so I kind of like that. Like you want to sell some money, you can't listen when some triples on. You got to sell it. It was I interrupted you. Sorry, go on.
They just beat earnings and once again gapped higher. And the only problem whenever we do this, we risk that we are goochering it by basically.
Well, you know what? We told Bill that we were going to feature it in this week's top five,
so that he
and we asked for some. We asked for some money, and he didn't give us any. So we said, "Well, we're going to feature it. You're done. You better sell your stock." You know what? To be truthful, we pulled this up. I pulled up the S&P 500, and I looked at the best performing stocks of the year, and I was quite surprised to find this as being one of the top 5.
Yeah,
and it's been a great story.
What a run!
It's been a great run, and it's over because we just talked about it.
Yeah, it's over. We just Hulk smashed it right here.
Yeah.
So number 4, Apple earnings next week on the 30th. And so, I mean, Apple has not really got the last wave of gusto to push. But I think this is going to be an important crossroad because, if it disappoints and gaps lower, you know, technicians will see double tops all over the place, but I'm just saying, like, you know, it might roll over, but at the same time, if it pulls a Google, gaps to a higher high, I mean, we might see it go shooting right back to 240. Right?
It's not pulling a Google, man.
You don't think so?
It's going to be a Netflix before it's a Google.
Really, you're that bearish, eh? I know you were bearish 2 weeks ago when
when it was $180.
No, because who left the company again? It was
Johnny Ive, just because he has the same haircut as me. Anyways, Johnny Ive. I just think this company, it's a big company. You get to a certain size, it's tough to grow. I feel like there's more than just that. It's a long story. I don't think they're innovating as well.
You know what?
The only thing I will say is that this latest, this recent Apple keynote or whatever they had, they're once again showing signs of doing a little bit more innovation. But at the end of the day, it's such a big company. It's hard to move the needle. I think it's going to be difficult for these guys to keep growing.
You want to hear them move the needle? They just have to pull a Mark Zuckerberg, announce some sort of like crypto type of thing that's going to happen.
They're not going to do that.
Well, I'm saying if you ever wanted to see a catalyst that's going to cause investors to give a higher multiple, you just got to fire up all of the cryptos up, and they'll chase anything. I mean, you saw what they did to Kodak stock.
I know, but this is too big. They can't move. This is the biggest company in the world.
They moved Facebook.
Yeah, it wasn't just the crypto guys, though. It was a lot of things. Well, I don't know. I don't know what I'm talking about, but I don't think that's going to happen.
I don't think it's going to happen either. All I'm saying
I think it would be more likely that they buy Tesla than they do crypto.
Really?
Yeah. They looked at Tesla. I think that if Tesla were to shit the bed and get into real trouble, that these guys would take a serious look at them.
Well, sure, if they're buying it as a distressed asset.
Well, yeah, I think they just don't want to chase it.
Yeah.
Although they bought that Beats headphones at some stupid price, so that they're not. It's not like they're above doing stupid things. Okay, number 3. Let's go.
All right.
Okay, this is
you
mine.
had something saved up.
Okay, yeah, because I remember a certain bet, and I remember a certain podcast partner that gave me a lot of shit back in, what was it, April or May, when semiconductors were rolling over, and
Right.
I said that they might do better than everyone expects. And I lost my burger bet. I
Yes,
lost
you
my
did.
burger bet. It was a good burger. I took you to
I
Burger's
enjoy-
Priest,
I
which
enjoyed
you've
the
never
burger.
been to, which I'm just shocked at, like very surprised. But I took him to Burger's Priest, one of the best burger shops in Toronto. But the thing is, I just wanted to bring this up here because these things are running. And you have to, I just want you to say, Kev, maybe you weren't as wrong as I thought you were. That's all I want. I don't need you to say I'm right. Just say, maybe you weren't as wrong as I thought you were.
Maybe you weren't as wrong as I thought you were.
Right, because look at this thing. Semiconductors hitting new highs into this thing. Like, this is crazy.
So are you buying here? Come on.
No. I
thank you.
become bearish here.
Yeah, no shit. I'm like, you're the ultimate contrarian. There's no way you're buying the high. That's
Okay,
what technicians do.
Yeah. So let's look at AMD, because actually I think that one's interesting as heck. This thing, like, is there a better looking chart out there?
Yeah, the SMH one we just looked at earlier.
No, this is a better looking chart than SMH.
Why?
Oh, this is just chug without any real dips. I disagree with you completely. I would buy AMD. I'm not much of a technician, but I think
this
that
looks
okay,
like
well,
a chart.
So
of
everyone go and weigh in. What is a better looking chart, AMD or SMH? And if I don't win that one 3-4, I'll be shocked.
Okay.
3 out of 4. I think that out of 4 people that vote, I think 3 will be on my side.
All right.
I'm gonna tweet it out. Yeah,
tweet it
for
out.
sure. Because you're like, I don't know why you can't say this is a great looking chart.
I'm not. All I'm saying is that semiconductors weren't a bad looking chart either.
No, but this is a way better looking chart. Pull up the settings again.
You just like the fact that during the pullback, this thing never tanked like the rest.
Yeah.
Congratulations.
Okay, well, anyways, let's go on.
All I'm saying is that SMH gave you a better buy on dip.
Yeah, I don't want that. I'd rather just have the stock that's going to chug higher.
All right.
Okay.
Well, anyway, AMD, nice looking chart. We'll give you that one. All right. So number 2, the U.S. dollar. And see, as the ultimate contrarian, I'm sure there's no way that you're buying into this breakout, are you?
No, you're absolutely right. I actually today, Friday, started in a position.
Oh my god!
And when
just
I asked
advertise it, you're going to advertise it, but you're going to Gucci yourself.
I'm an open book, baby. I'll tell, like I say it all the time. I'll tell you what I'm going to be wrong. So
well, you're going to be taking my money because I'm long the dollar.
Okay, This is my plan. This is my plan. My plan is to put on a little here.
You just said you did.
Wait. Yeah, I know. A little here. And then I'm going to put on a little more when it breaks out and all you guys get so excited about the technical breakout. When I start to hear that, like,
clever.
That's my point. So when I start hearing everyone tell me how
every technician's going to have this line, and you're going to wait for the prairie dog. So you're gonna wait.
I don't know if I'm going to get a full prairie dog or I'm just going to wait.
And then you're going to get short up there, and then it's going to break to a higher high and wipe you out.
Could be. I won't deny that at all. Okay, now you might say, why are you shorting the dollar? Okay, I'll tell you
Kevin,
why.
Can I set you up for that? Kevin, can you please explain to us why you're shorting the dollar?
Okay, I'd love to, Patrick. People think that the dollar goes up when the U.S. economy is strong. But the truth of the matter is it goes up when the U.S. economy is stronger than everyone else or when credit is contracting, when things are really bad. So that's kind of the two perfect things. Because basically when things are bad, credit's being paid back, and therefore it being a reserve currency, you get a situation where the dollars are getting paid back and there's a demand for dollars to pay those back.
Right.
I think we're going to have an global economic upturn.
Okay.
And when we have that global economic upturn, we will get the smile effect on the dollar, meaning that it won't be bad or good, or it won't be so bad that it's going up, and it won't be so good on the American side that it's going up. It'll be just good. And if you look at when we get those times, those global economic upturns, often the dollar goes down. Because what's happening is credit is getting created. And when credit is created, it basically, there's more dollars in circulation and it goes down. And not only that, I know that we saw that Larry Kudlow today said something to the effect that he didn't think that, the President Trump didn't want a weak dollar policy, but I call bullshit on that. They of course want a weak dollar policy.
Oh yeah, I could just imagine that one picture of Donald Trump with like 2 explosions out of each ear, just like
you think?
I think he'd be all over Twitter if the dollar broke out.
Oh, I see. But I thought you don't think that he okayed what Larry said?
Oh no,
you don't.
Well, you think so? No, I mean I don't know.
I think
all I know is that Trump will try to talk down the dollar if it breaks out.
So you're long and you think it's headed a lot higher, right? Like you're like one of those dollar.
Well,
because the world's coming to an end and it's
okay.
Yeah. You gotta
buy guns and ammo. That's all gonna happen. No.
Anyway, so that's my theory. I just I'm starting to lean into a position starting today up here. Maybe I'm wrong and it breaks out, but I'm ready to give them more when it does. And nothing would get me more excited than everyone getting excited about the breakout.
All right. So number 1. By the way, you're the ultimate contrarian. It's awesome. So number 1, FOMC. Obviously, the long-awaited July meeting is here, right?
Yeah.
And so what's your thinking? I mean, do they do 50 points?
No. Do you honestly think that's a shot?
No, I don't. I think they do 25. But the thing is that if they're not dovish enough, what do you think is the market impact? I mean, if they only do, first of all, they have to do at least 25, right?
For sure.
They're not going to do 0.
There is 0 chance that they're going to do 0.
Right.
Obviously, there's never 0, but it's
consensus.
Like it's one.
It's consensus. They're doing 25.
500 or something. It's so low. Like there's no way. They're doing the 25. They've signaled it. I think they've also signaled quickly.
But you don't think they'll push the dollar higher if they only do 25?
No, it's okay. So this is what I always hear. Dollar sometimes trades on interest rate differentials, but the majority of the time it does not.
But I'm not saying from that perspective. I'm talking about the tone of dovishness versus hawkishness. Like I understand your scenario. If they gave 50, and they come across super dovish, the impact on the dollar, but they only give 25. I mean, I think the dollar is rallying now because everyone now is realizing they're only going to do 25, right? I think it's dollar bullish. Yeah, I mean, you're already fading it because you're the ultimate contrarian.
No, that's not why. I feel like the dollar is rallying.
Think
right
about
now
it. You started shorting the S&P the moment it made a higher high. You just immediately had to be a contrarian. I just think that you're just.
So actually, I'm getting a little nervous about my S&P short too.
Right.
So I'll tell you one thing.
How many days will the dollar index above 98? How many days above 98 does it have to stay there for you to start getting nervous?
No, it's more what other things are doing. And what I worry about with the S&P now is the fact that the S&P, we have a situation where I think that this month might have more liquidity coming into it than we expect.
Really?
I spoke to our good buddy Barton. Barton, and this is the Treasury General account. And I went through some things, and he's been helping me with this. And I was worried that the pain. I'm a big believer that paying down and pre-funding or running down.
This is all about
account.
the debt ceiling thing with that account.
Right. And I was kind of concerned that might be a problem, and he's walked me through why he thinks that this August will be fine. There's no signs that there's going to be liquidity requirements in August. And I think that was kind of, for me, was what I needed in terms of getting less bearish about stuff. Now, I will tell you that the more I see commodities sucking wind and not getting a bid, the more nervous I will get about the stock market. That cannot continue forever.
What is your raw index there?
Oh yeah, the CRB raw index it continues to suck wind. Like, it's really bad. Like, it's not bouncing. I need that to bounce, and it's so far it's flatlining at 450 still the whole week. But at least to stop going down. And if we get a situation where these things get a bid, I could see the S&P pushing up to new highs, and I would rather sell that rally that gets everyone really excited than in here. So I've actually pulled back on my shorts a little bit, and I'm ready to sell it once all the technicians tell me it's going higher again. There's not enough technicians telling me it's going higher.
All right, enough said. All right, so Kev, that's okay. Anyway, ladies and gentlemen, that was your top 5 with Kevin giving you real conviction, right? And so, what's their parting words of wisdom here, Kevin?
Okay, this is Marty Buzzy Schwartz. This guy is I don't know if you've ever read his book Pitbull. It's a hilarious book.
You referenced it before, yeah.
Oh yeah, my favorite part is when he went. There was, I think it was the '87 crash, or it was some sort of market event, and he was worried about the financial system imploding. So he went and grabbed all of his gold out of the bank.
Right.
And it was on New York City. He was running up the street with all of his gold, and then he proceeded to have not a heart attack. He basically was really sick, and he had like some sort of virus that was pushing on his heart, and he collapsed. And it's just, when you hear him tell the story, it's a pretty friggin' funny story. Like, the guy is a funny guy, and he's a real trader's kind of trader. And if you haven't read the book, there you go. Pitbull, great book, old school, talking about trading S&P. When you go see the quotes, when you read it, you'll be like, what the hell? It's like when the S&P was like 132 or something. Like, it's crazy, like what he talks about. But anyways, I'll read you his parting wisdom because I thought it was really good. The most important change in my trading career occurred when I learned to divorce my ego from the trade. Trading is a psychological game. Most people think that they're playing against the market, but the market doesn't care. You're really playing against yourself. You have to stop trying to will things to happen in order to prove that you're right. Listen only to what the market is telling you now. Forget what you thought it was telling you 5 minutes ago. The sole objective of trading is not to prove you're right, but to hear the cash register ring.
Wow.
And I actually like that one because I talk about that on Twitter every now and then. There's lots of guys who get on Twitter and fight all the time, and I refuse to get on Twitter and fight because I think that it all squares up in the P&L. All this stuff, you could sit around and we could talk and we could disagree about shit, and nothing matters, Patrick, except the P&L.
Right.
You could be the biggest doofus in the world, say the dumbest things, and if you're ringing the register and, making a good living, that's what this is all about. So that's all that matters to me. I have no desire to kind of convince someone I'm right. You got to trade what you got to trade. You got to trade your way. But I thought this was some really good kind of advice from him, because the sole objective of trading is not to prove you're right, but to hear the cash register ring. Don't forget that. That's the last sentence Marty said there, and it's super important.
All right. Words of wisdom from Kevin. All right, so Zach, welcome to the After Hours here. We're going to just talk about some fun stuff. Now, first of all, you just said you interviewed Jesse Felder. So you were earlier talking to us about value plays and retail. Did Bed Bath & Beyond come up at all in that interview?
No. And it's funny you bring that up because we've looked at it peripherally, glanced at it. I don't know the story on that one. I know some of the surrounding aspects of it, but no. And why do you ask? I'd love to hear why you're asking.
No. Jesse brought it up when he was on Macro Voice. So he that's why I figured, because you interviewed him, that he might have brought up the name when you were interviewing him, but clearly he didn't.
No, he did it. He didn't, and I, in our peripheral glance at it, I just felt like in our opinion, I thought there were some other names that looked a little more attractive.
Right.
So now Jesse's not in Seattle with you, right? Like he's out in the other. What's the fancy place? It's kind of like another town it's more in the mountains, right?
Yeah. He's Bend, Oregon.
That's
so
right.
he's about if we doorstep to doorstep, he's about 5 hours away as far as driving goes.
Oh, it's a long way.
And
it's a long way.
Yeah, and he lives, and it's just gorgeous. If anybody can ever get up to Bend, Oregon, I totally understand why he moved up there. It's just spectacular.
Yeah.
And now Seattle is a lot like Vancouver, right, in terms of the rain?
Yeah. I mean, I've spent time in Vancouver, not extended, but I think and you guys can, feel free to chime in on this as well. It gets downright depressing in the winter, but the summers are just spectacular. It's absolutely fantastic. But it's kind of like, in terms of weather and climate, it's kind of like being a teacher. Like, why do you live in Seattle? Because of June, July, and August,
Yeah.
Outside of that, though, man, I'll tell you, around February or so, my wife and I try to get down to Mexico at least once a year during February, just to, restore some sanity, because you start feeling like a vampire.
Well, that's how most Canadians are. So we're the same way. We all have to leave.
You guys are just you're just a lot more polite.
That's about yeah. No, but it's you get the rain. We have like just constant snow and slush. It's just slightly different, but. I got to tell my favorite Vancouver joke, because I always like telling this. This fellow dies, and when he goes down and he's about to get judged, he's in this long line, and they're all waiting to get judged by Satan, and he's watching the line go.
Is this St. Peter?
No, this is Satan.
Oh, Satan. Oh, okay.
And so some guys are getting sent up to heaven, some are getting sent off to hell. And then every now and then he sees one person get thrown off onto this ledge beside him, and they just have to wait there. And he finally, he's waiting his turn. He finally gets to the end, and it's his turn to be judged. And he says, "Wait, oh dark Lord, before you proclaim my, where I'm headed, could I ask you a question?" And the Satan says, "Sure, no problem." He says, "I see people going up to heaven. I see people going to hell, but I see these other people off to the side. Who are they?" And he says, "Oh, those people are from Vancouver. They're too wet to burn."
I love that. I love the Canadian jokes. I've used this one on you before, Kevin. How do you make a Canadian apologize? You step on their foot.
That's true. Actually, we're actually really bad at that. I must admit. Somebody bumps into you.
God knows we could use a little more of that.
We bump into people, and like someone bumps into me, and I say sorry. Like I completely. Yeah. That's funny because it's not even a joke. It's like the truth. Like we're so bad at sorry. It just kind of instinctually comes out. Oh well. Yeah, anyways, it's kind of funny. But I find that Seattle people from the northwest of America, they're almost like we're very similar. It's not like we're that different. Like it's I bet you if you go look at a Vancouverite versus someone from Seattle, what do you call someone from Seattle? I don't even know what you say. Seattlean?
I guess a Seattleite.
A Seattleite. Oh, that's kind of That's kind of cool. I actually didn't know that, but I bet you'd be hard pressed to tell the difference. Like no.
No, man. And it's my wife talks about this all the time. You know how everybody talks about New Yorkers being so rude and everything?
Yeah.
Living in Seattle, if you travel anywhere else, you're just dumbfounded at how open and conversational people are. There's this really weird, just kind of everybody's really keeping to themselves. If you look at somebody in the eye, hey, how you doing? They kind of look at you like, oh my God, is something wrong with me? It's kind of a weird. It's kind of a weird culture. It really is. It's
I
kind of
didn't
bizarre.
know that. I had no idea.
Yeah,
I kind
of should try going there one time, Kev.
Well, yeah, no, yeah. I have been there, but I drove through. It was Expo 86, which is a long time ago, and I'm sure Zach was probably wasn't even born yet. Were you like 86? Like, did you go up to Vancouver?
No, I was 4. I was born in 82.
Yeah, so you're too young. But I drove across and I got to go to Seattle. So I have been there, Patrick. It's been a long time, though. There wasn't the Starbucks in every corner like there is now. I hear there's
now there's 2.
Yeah, I hear there's one corner. There's 4. The original corner.
Oh, Yeah, this happens all the time. So because of the show, we've got clients all over the place, right? And we drive to go meet them. Typically, most don't want to come down to the office because our office is about 25 miles south of Seattle, actually. So, and we meet people, and 9 out of 10 times we're meeting at a Starbucks. And I cannot tell you how many times you pull into a shopping mall or a strip mall, you walk into a Starbucks, you think the client has stood you up, and they're literally across the parking lot at the other Starbucks. It's like it's it's mind numbing to me. At some point, saturation's got to be there. It's certainly here. It is, but I'm there. I mean, they're everywhere. It's unbelievable.
Yeah, there's the original Starbucks that I hear like people wait in line for like 3 hours to get into, and then right across the street there's one that you can walk in and just grab a drink.
Yes, I've actually done that before.
That's crazy. That's crazy.
Oh well,
Zach, I gotta ask you. I want to change the topic a little bit. So you have your own little radio show there. So when did you start it, and what inspired you to get the whole thing going?
I think we're coming up on 3 years now, I want to say. And you know what? Honestly, so frustration. So I started off at Russell Investments, and I played college football at a small school here, Division III, and so just kind of grew up a competitive athlete, and loved finance. I was born into it, never considered doing anything else. And so I wanted to, but growing up in a BD, I knew that I didn't want to, everybody thinks a family business sounds great until they're in it. And so I wanted to be on the institutional side of things. So I went to work for Russell, and I was really frustrated and disappointed by the bureaucracy of it all. And so that's why I accepted the job as being a broker. Then I got into that. And when Wells Fargo tied our compensation, well, that was a whole nother story too. I signed with AG Edwards. Within 3 weeks, it was Wachovia Securities. Within 2 months, it was Wells Fargo Advisors. So that was kind of it was a wild ride. And so about 4 years into that, they started tying our compensation to credit card and mortgage sales. And I just went, okay, this is it. So went out on my own, joined the family firm, and we just wanted to grow it organically. And we got approached by a radio station up here and said, hey, we've got a spot. Would you guys, would you like to do it's marketing. So we had to pay for it, of course. And they were like, okay, here's the format you should use. And I'm a podcast junkie. And I just thought, hey, what if we, let's blow, I don't have any interest in doing a 1 hour, what do you cut? Where it's like a 1 hour ad on TV. I'm blanking out right now, but
infomercial.
It's all scripted.
Infomercial.
Yeah, exactly. Yeah. I had no interest in doing that, and we thought it would be valuable to do a format kind of like Macro Voices, but make it more accessible, to not gear it toward the institutional investor. Right, try to make it more digestible, and we said, okay, we're going to give it a 6-month run, and we'll see if it works. Right. That was 3 years ago, and last year alone, off just radio, we brought in over 30 million in assets. So it's been awesome. It's been a real blessing, and it's been so much fun too. I wouldn't be sitting here talking to you guys had we not done it. And it's been it's been a blast.
So you have no radio training?
No.
Wow,
no.
that's amazing.
I grew up.
Because like when I was on your show, I was like, oh my God, this guy's like a full-on radio guy, and you're like doing the commercials, and it's just awesome. Like, you were terrific. I was like, I'm actually surprised. And when did I come on? I would have come on about a year ago, maybe a year and a half ago. So you were probably a year into it or a year and a half into it.
Yeah, and you were one of our first, actually. I think our very first one, we had Raul Paul on, and we just scheduled him again just because it was right when they were in the thick of just launching. They were probably only a year into Real Vision, and he was kind enough to come on. And at that point, we didn't have a podcast. We weren't even podcasting at that point. It was just radio.
Right.
And I think you were like number 2 or number 3 right after Raul.
Wow.
He's actually going to be coming on. Yeah, he's going to be coming on in a month or so to kind of do an update of how far both companies have gone since then, and kind of go revisit things.
Oh, well, that's great. So listen, we can't let you just talk about all the non-market stuff. We have to end with a little bit of inflation talk, because I believe you're more in my camp. And so I always, whenever I get somebody that's willing to kind of give Patrick the gears about all of his deflation crap, I'm always looking for somebody to kind of gain up on him. Why don't you tell me what you're thinking, what you think the chances of these guys with their, our economies collapsing from deflation are actually, like, what do you think the chances of that occurring and what the real problem is for our society going forward in the next 10 years?
Okay, well, first of all, I love hearing you guys go back and forth about it, because it really is. It's like the conversation I've got going in my own mind. It really is, because I see so much what Patrick's talking about. Yet at the same time, when this whole thing started back in 08, 09, I remember, spending a lot of time looking at it and thinking, if there is no constraint to money printing, if there is no constraint whatsoever, I don't know that we can have a deflationary collapse. And my inner value investor just cringes at that idea. Yet at the same time, it's kind of that whole Minsky moment thing, right? Where if something horrible can happen that can throw it all in reverse, it's just a matter of time. And to me, the thing that takes the key, and I'm not the first guy that said this, but not even close. But to me, if there's anything that takes the keys away, that really causes the most amount of pain, it's the inflation side of things. And but boy, is it just confusing right now, because the world is obviously choking on debt, and you can see how those dominoes would start to fall. So I'm going to I'll kind of ride the fence here. My personal outlook is, I think that we're going to see, it just seems culturally to me, especially here in the US, that we will see a deflationary type collapse. And that's when we will just go full tilt MMT. I fear that it could, I fear that it could usher, that it could usher in a Bernie Sanders type presidency, and then from there it's Katie bar the doors.
Yeah, so you're actually a Patrick guy, so that's okay. I still like you, Zach.
I welcome you, Zach, to the.
Because actually, Patrick is more that way as well. Patrick always tells me
my deflationary narrative is really a 1 to 3 year time horizon into the turn of the next business cycle. Because you're absolutely right. Because once we're in that cycle, they're going to do anything and everything to get us out of it, and that's when the more inflationary narrative has every chance of becoming reality. And so I'm not a long term deflationist. I think that.
Yeah, and Patrick, I'm so sympathetic to both takes, but culturally it fits so well too, right? Because we've got this, again, especially here in the States, there's this rise and there's this big push towards socialism, and it just seems to me, and we both know, right? Free markets are not what created this problem. And in my view, this problem started in 1971, and it's been an unavoidable consequence. It's been a train coming down the tracks since then, But when this next collapse happens, you can just hear Bernie Sanders up on stage. See, we told you. It's going to be the final death knell. And everybody will – I can just see everybody capitulating and going, okay, that's right. We got to go the socialist route. That narrative just seems so clear.
Yeah, and for those who don't know, 1971, you kind of referred to that. That was not the year that that the music died and the 60s ended. It was the year that Nixon went off the gold standard. So I take it you're a little bit of a gold bug. What do you think about the gold miners here?
Man, we're a gold bug, but I've got an interesting relationship to that. So my dad is actually the CEO of a ultra micro cap gold mining company based out of Colorado. And so I spent multiple of my life at mine sites. I've been underground in Canadian mines, and it's kind of grew up in that industry. And so, if you're close to it, ironically, I feel like it kind of precludes you from being a gold bug, because you see the swings, and you know that when it's good to be in, it's good, and when it's not, get the hell out of the way. And so I think that I love Luke Groman's his saying or his colloquialism, if you will, where he says that he thinks that eventually gold is going to be the credit default swap of this cycle. I think it will be too, and then I think that's probably when it'll be a time to step aside and get out of there. But the miners on a valuation basis, I think that I love them. We have a modest allocation. We have a modest allocation right now to them just because I'm not. Once bitten, twice shy, but I think that that's going to be a great place to play.
So, Zach,
Don, one second.
I'm asking you. Kev,
I don't want to tell you. I just want to say something, Patrick. I'm going to interrupt for 1 second, then you can ask a question. Zach, there's something. Don Cox, who's a famous strategist in Canada, he has a line. He says, "Those who know it best love it least because they've been burned the worst."
100%. 100%.
Now we'll let Zach. Patrick, go ahead.
No, so I have to ask you. Okay, so Zach, obviously as a money manager, you're going to take diversification. You're going to put some ETFs and stuff. But is there a particular gold miner that has your fancy? I mean, you've been in the mines, you've been in all this stuff. Is there one that's like your little favorite that you play favorites with?
I hate to admit this, but because of the last 5 or 6 years, I'm not as current. When I see a move start, again, from experience, I usually express it, or if I think we're going to catch a good move in gold. We were lucky enough to we went max long for us in our portfolio, which is a 25% position, and we split it between gold, the actual metal, and the miners in December, GDX and GLD in December of 2015, and caught that move. And just as we started allocating into the single miners again, at that time, I thought Kinder Morgan was interesting just because it had so much negative sentiment, and it has that pretty prolific mine there in Russia that is really being discounted because of geopolitical risk, and rightfully so. But Pretium is another one that I'm really interested in. I think it's a horrifically misunderstood company. It's an underground high-grade miner, and it's going to have lumpy results. But when it's good, and it's the exact same type of mine that is the mine that my father runs. And when my grandfather was personal friends with Bob Quartermain, there's not an ounce of fraud in that company. There just isn't. And it's a phenomenal property. And there, like I said, if you can take some of the volatile, and that's the thing about gold mining, if you want those spectacular grades, they're going to be lumpy. It's just the way it is. But I think that thing is horrifically underpriced. And if I had to go one way, my favorite, it's probably Pretium.
What's the symbol? Cool. Jinx.
PVXG, I want to say. It's different because here in the States, we've got to do the ADR, or the US listed one.
How do you spell it?
It's Pretium, Pretium, but the U is actually a V.
PVG.
I don't know why they. Yeah, PVG. Yeah, and I think it's PVG.X here in the States or something like that.
Oh yeah, we trade that one too. It's trades in Canada as well. PVG.
Yeah, I think it's an incredible company, and I think it's the property is really incredible. The grades they're pulling out of there are insane, and a lot of the analysts aren't getting it because they're trying to comp it to an underground mine, or an open pit, and your production and your grades are going to be so much more consistent out of an open pit. But Pretium's grades and the mining industry, it all comes down to grades. What is your cash cost per ounce, and what are your grades? And when you look at their grades and you look at their cash cost per ounce, when they're in it, it's gonna swamp out the lean periods, and I think it's really underpriced.
There we go. Okay, PVG on Toronto and New York. So Zach, we're gonna let you go. Thank you so much for coming. It's been a pleasure having you. We look forward to having you on again.
All right, fellas, it's been a blast. I appreciate it. Love your show, and Patrick, love the work you do on Macro Voices, and I'd love to come on and chat with you guys again.
All right.
Take care. Thanks again.
All right. Cheers, Zach.
All right. Take care, guys. All right.
Thanks.
Bye-bye.
Bye-bye. So that was a good show.
Yeah. So Lena, hop on.
Well, we have some closing words, don't we? Like, where can everyone follow you?
Oh yeah. Sorry. You can follow me, Kevin Muir, at Kevin Muir, and And you can follow the Macro Tourist at themacrotourist.com.
Absolutely. And you can follow me at Patrick Ceresna. And you can go to my website, bigpicturetrading.com, and visit Kevin's Macro Tourist blog.
Yeah.
Right?
Now,
anyway,
Lena, hop on. We got to do our beer review.
Yeah.
Oh, right.
So the cat on the unicorn, first of all, you got to give like an A+ for the logo. No doubt about it.
Yeah, for sure.
Yeah, no doubt about it. Like
A+.
those guys, these guys like their.
They were on drugs when they.
For sure, they like their hallucinogenics. Like there's no
their
doubt.
website is hilarious. If you go to their website, it's everything that's written there is hilarious. You need to go
Okay.
to carbon4.com.
So these guys are from Wisconsin.
Yeah.
And we got it. Yeah, we got the American. It's good. It's good beer. It's actually a little strong. So.
What do you mean a little strong? This is great.
It's 6.3%.
No, it tastes a
that's
little
why I'm
strong.
slurring.
Yeah, no, it tastes a little strong to me. Like it's a little bit still. I still, I'll drink them, but I don't like the ones where I taste the alcohol, and I still taste the alcohol. So for me, it's gonna get a lower. It's gonna get a lower number because of that.
Really? So what are you rating it?
Okay, well, I am gonna go 7.1.
What? Really?
Wow, that's harsh.
That is.
Why?
You're mean.
I'm not mean. Like if you think about it,
I mean,
7 point. It's still a good score. It's not like it's a sour. Like wait till we get a sour. Those are gonna score in the like 1s and 2s.
All right. Well, we'll save that for then. Lena, how about you?
I think I'm gonna rate this 8.4.
8.4.
Lena, I think you just like beer. Lena's like, it's beer, I'm in. It's 8.4, 8.5.
We should
All
write.
beer is 8.
No, but we haven't graded sours yet.
Yeah, you know what? Next week, a sour.
Lena, can you write down our scores moving forward, not backward? Like I want to be able to go back, 3, 4, 5 months from now and see how we rated all of these compared to each other, because we're gonna forget all of these. But for me, the moment I started drinking this, I was saying that this is like the most wicked tasting beer. I love this. And I am totally giving this a 9.01.
No, one digit only. Let's be
Well,
serious.
no, I can't. I'm giving it more than a 9. So you're not gonna let me. Okay, so 9.1.
That's saying a lot.
I love this. I would go right now on a road trip to Wisconsin to buy another case. By the way, you can only buy this in Wisconsin. And so now, in order for me to get more of this beer, I am going to have to go to Wisconsin. And so now I've got a reason to go on a road trip. That's my rating right there.
I feel like you guys are way too easy with the marks. Like I feel like you guys just.
What do you mean? I've never given a grade this high ever. I've been way lower than you on everything.
No, you haven't.
Yes, I have.
Yes, I have. What were you saying, Lena?
You just like to disagree. Kevin, so what beer would you rate higher than, let's say, 8 or 9?
Well, my favorite drink is the Granville Pale Ale. So like that one to me is like that's a 9.3 or something. Like nothing is going to be a 9.5
That's like
to me.
that's a light tasting. Yeah, that's a nice crisp beer.
Oh, you know your beers. I like it, Lena. Okay, so we got to give Patrick a little bit of a hard time. Where are you going, Patrick? We're taping this a little early because Patrick's going somewhere.
Going camping.
You're going camping and not glamping like you gave me a hard time about.
No.
So this is true Canadiana. You're going in, and the reason we're taping early is because Patrick has to make sure he gets to.
I got to canoe out to the site before it gets dark.
That's right, because you don't want to canoe in the dark. That's bad.
No, but I mean the thing is that you don't want to tip and
tent?
lose all the beers. I can bring you a whole case of beer with me, right?
That is really bad. That is really bad.
Why?
Yeah. If you lose all your beers.
Oh no, that would be bad. Okay, I thought it was bad that I was bringing beers. No. You don't want to. No, so like you have to. I'm gonna put a life jacket on the case of beer.
Now that is smart. That is smart.
Not on yourself, just for the beers.
No, yeah. Why do I need one? I know how to swim. The beer doesn't.
Yeah. No, I completely agree with you. Like,
who cares about if you lose the tent? You can sleep on the ground. The beer has to make it, right?
For sure. Yeah, I actually have a story when we went to do this thing called Tuckerman's Ravine in New Hampshire, and it was me and a guy that I used to deliver bonds, like back when they settled bonds like by hand in high school. So I would go and there was me and another messenger, and just like these messengers, most of them were just like druggies. And anyways, we decided we were going to go, and he was from out west, and we were going to go do this Tuckerman Ravine, which is a very famous kind of ski hill in New Hampshire where you climb up and then ski down. And so we went and we decided we needed some beers for the weekend. So we basically each took a case of beer. And then the haul up there was way worse than we ever imagined. So, like, do you think we left our beers on the side of the...
No.
Of course not.
No, you left everything else.
No, we drank them.
Oh.
Even better.
So we got to the thing and we were like, we can't ski today. We're just so screwed up. Oh, you know, like, what's the joke about who said that, like, canoe is, a Canadian is someone who knows how to have sex in a canoe? I think was it Pierre Burton or was it Pierre Trudeau? I can't remember.
That's so funny.
Yeah. Oh, you never heard that? That's
no. That's a skill because I can bear, like, I'm paranoid when I'm in a canoe. Like my balance is just not right. I'm old because I guess I'm a little bit drunk when I'm canoeing, but like like if you can do that, you can have sex in a canoe. That's a champion.
Yeah. Well, that's a Canadian.
Special skill.
Well, yeah.
There you go. That's what else was I gonna say? So, Lena, what do you got planned for the weekend?
For the weekend,
Yeah.
I actually have a baby shower to go to.
Oh God.
Yeah, that's what I said.
Have you got the gift already?
Oh yeah.
Are you guys gonna put like the dumb hat on her and stuff, like, or whatever?
I don't know. I don't
You guys
know.
are millennials. You'll
It's
probably
a pool
do something
party,
cool.
So we'll see.
There you go. It's a pool party. You guys are millennials. You'll do something cool instead.
Yeah, I guess.
Yeah.
We'll see. I'm not good with baby showers, wedding showers, any kind of showers. Like I'm not a big wedding.
But you'll do
person, I'm not a baby
bachelorettes.
shower person. No, I don't like those either.
Really?
What?
Yeah, I'm not a big, like, I don't know. I've always had guy friends growing up, so whenever it's like a female only sort of event, I get really awkward.
Okay.
I don't know if that. I don't know why. But
I find it awkward when I go to the bachelorettes and the baby showers as well, and everyone's looking at me like, "What's this guy doing there?"
Why are you here?
Why are you there? The new trend is like those Jack and Jills and all this stuff.
Okay, so wait, I gotta tell a story, Lena. You're
All right.
gonna laugh at this. So Saturday night we're in Chicago, and we're going out with Patrick's buddies, and it's as much as I tried to stay nice and sober for the next day, I kind of failed. And we go out to a bar, we eat. It's like basically got a lot of cheese and like it's Chicago, so it's bar food and it's great. And then we go out and we end up at this pinball place. And I have a question for you. When we got there, it was filled with millennials, which is fine. I felt like
Not even. It was Gen Zs, man.
Yeah, it's Gen Z. We were basically like the creepy old guys, okay? So that's a little awkward for the first thing. And Patrick and I are just going, we're like way too old to be here. Our kids will be here. This is a little creepy. You're just like the creepy old man. But then the thing about it is that all the video games were from the 80s, which was really cool because there was no charge on them and we could play like Centipede and all these crazy old games. But the interesting thing about it was they were playing 80s music. Like, I swear to God, it might have been like 1986. Like, do these Gen Zs think, like, do they actually think, like, the 80s were cool? Or, like, is this typical? Or is this, like, I don't think it was retro night.
It's like something about the 80s that were, there's shows now, right?
Yeah, like Stranger Things and stuff like that.
It's super 80s, and I think that made
I have only horror
cool,
dreams about the 80s. And
well, you know what's funny? Yeah, come on. The fashion was fine. It was great.
Oh my, it was horrible.
No, I disagree with you.
I
actually like the fashion. It's the 90s that were ugly.
90s was bad.
Yeah,
90s.
I completely agree. You know what's funny about Stranger Things? My kids watch it, Lena, and what happens is that the kids in there were born on the same year as my wife and I.
Oh, wow.
It's kind of funny. It's kind of like we're like, oh,
that is pretty cool.
Yeah, it's actually the
that's
same.
cool.
It might as well be us.
Oh, wow.
Anyways, we should probably let Patrick go because he's got to go and paddle out to the thing before it gets dark.
I gotta go get my canoe.
Don't forget to put the life jacket on the beer, buddy. You do not want to lose that.
That's right.
Oh, I agree.
We're drinking.
That is a priority, dude. All right.
Okay.
All right. Have a good weekend, everyone. We'll see you guys all
take
next
care.
week. All right. Cheers,
Have a good
everyone.
weekend.
Bye bye.
Okay, bye.